Welcome back to the Working Thesis. I am Maya, and today is Tuesday, July 14th. We have a fascinating market puzzle to unpack today. On the surface, the story looked like a massive sigh of relief. We got a cooler than expected inflation report. We saw absolute blowout record profits from the big banks, and the stock market threw a risk-on party. The semiconductor stocks that got so brutally crushed on Monday? They came roaring right back to life today.
Hey everyone, I'm Theo. It really did feel like an all-clear signal at first glance. The margin calls stopped, the forced selling reversed, and buyers stepped in. But if you look just under the surface, there was a glaring, flashing red light. One major tech stock, IBM, absolutely crashed today, down 25%. And its warning tells us something the rally is trying to hide, and it is subtler, but arguably bigger than the first headline suggested. The scramble for scarce AI hardware is starting to crowd out the rest of the technology budget. It is a fascinating, tangled puzzle. So let us dive into the numbers. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us look at the final scoreboard for Tuesday because it perfectly illustrates that tension. The tech-heavy Nasdaq was the clear leader today, climbing 0.9% to finish right around 26,107. Reclaiming that 26,000 level is a nice psychological win for the bulls after yesterday's flush. The S&P 500 followed suit, rising 0.38% to close at 7,544, and the small-cap Russell 2000 added 0.39% as breadth improved.
But then you look at the Dow Jones Industrial Average, and it was essentially flat, grinding out a tiny gain of just 0.02%. Why the massive lag? Because IBM is a heavy component in the Dow, and that single stock cratering completely dragged the index down. Meanwhile, underneath the indices, the VIX, Wall Street's fear gauge, fell almost 4% to settle around 16.5. So broadly speaking, the fear from Monday eased significantly, even with that massive IBM anchor weighing on the Dow.
The main fuel for this market bounce was the morning's inflation data. The June Consumer Price Index came in surprisingly cool, giving investors exactly what they wanted to see. Headline inflation fell to 3.5% year over year. That is a massive drop from 4.2% in the prior month, but the real star was the core rate, which strips out the volatile food and energy categories. Core CPI came in at 2.6%, which was nicely below the 2.8% economists had expected and down from 2.9% in May.
That core number is the one the Federal Reserve cares about most. When that printed below expectations, you could almost hear the collective exhale across trading desks. It effectively removed the immediate, near-term fear of an emergency rate hike that some Fed officials had been hinting at recently. The market looked at the data and decided that the inflation dragon is, at least for the moment, still being slayed. That gave the green light for risk assets to run.
With that green light, Monday's brutal, forced margin call selling snapped right back in the other direction. The semiconductor names that bore the brunt of yesterday's liquidation led the rebound today. Nvidia, the absolute bellwether for this market, rose about 4% to close around $212. Intel had a fantastic session, jumping 4.5%, and Micron gained nearly 5% on the day.
Broadcom also joined the party, adding 1.3%, and the broader semiconductor ETF, the SMH, rose 2.5%. What we saw was a classic relief bounce. The fears of escalating conflict in Korea and the anxiety over a hyper-hawkish Fed that drove Monday's panic both faded into the background thanks to that cool inflation print. When the forced sellers are done, the buyers do not have much resistance on the way back up. And that is exactly what happened with the chips today.
And we saw that risk-on mood confirmed across almost every asset class, not just in tech stocks. Gold, which had taken a bizarre dip yesterday during the deleveraging flush, recovered beautifully today, climbing about 1.4%. The US dollar, which typically spikes when people are terrified, fell back down. Bond yields ticked slightly lower across the curve, with the benchmark 10-year Treasury yield settling near 4.59%.
Even Bitcoin caught a major bid, jumping almost 4%. This broad, cross-asset confirmation is what traders look for. It tells you that this was not just a narrow stock market short squeeze. In the tug of war between the hawkish rhetoric we have been hearing from the Fed and the actual, tangible, cool inflation data, the data won today. Risk appetite came flooding back into the system, and investors felt comfortable putting capital back to work.
The second massive tailwind for the market today came from the financial sector. Bank earnings season opened with an absolute bang. JPMorgan Chase posted an astonishing $21.2 billion in quarterly profit. That is not just a good quarter. That is the highest quarterly profit in the entire history of United States banking. Their profit was up more than 40%, helped massively by a 35% surge in trading revenue. Ironically, all that geopolitical volatility we saw with the Iran war scares actually boosted their trading desks.
It was not just JPMorgan either. Goldman Sachs saw its profit jump an incredible 78%, while Citigroup and Wells Fargo both reported very strong numbers. On paper, it signals a remarkably healthy consumer and a robust credit environment, but we do need to keep it balanced. Even as he was announcing this historic, record-breaking profit, JPMorgan CEO Jamie Dimon still took time to warn investors about the tectonic risks facing the global economy. He is making billions, but he is staying cautious.
Now we have to talk about the day's real story, the one that completely disrupted the sunny narrative. IBM crashed 25% today. Let that sink in. That is a quarter of their market cap wiped out in a single session, marking their worst day in decades. They pre-announced a warning that their second quarter revenue and profit would come in significantly below Wall Street estimates. That kind of miss from a mature, stable giant like IBM is incredibly rare.
And here is where almost everyone misread it. So let us be precise. The knee-jerk headline was that AI is eating IBM's software. But look at what IBM actually reported. Its software revenue grew about 5%, with Red Hat up double digits. Software was a bright spot. The real miss was in infrastructure, down 7%, and that is the mainframe, the IBM Z. They were lapping a monster launch of their Z17 mainframe, so a tough comparison was already coming. Then, in the final weeks of June, clients suddenly diverted their spending to grab scarce, supply-constrained servers, storage, and memory before prices climbed, and a batch of large deals slipped. CEO Arvind Krishna called it a Capex reprioritization. So it is not that AI ate IBM's software. It is that the frantic scramble for AI hardware crowded out IBM's mainframe cycle.
So why does one company's mainframe stumble matter to the whole market? Because it exposes something bigger. For 2 years, the dominant story on Wall Street has been that artificial intelligence lifts all boats, an ever-expanding pie of technology spending. IBM just reminded everyone that corporate IT budgets are actually finite. When you rush to buy scarce, expensive AI hardware, that money has to come out of something else.
Exactly. It is a crowd out. The scramble for AI infrastructure is pulling dollars toward chips, servers, storage, and memory, and away from things like mainframe refreshes, while other deals simply get delayed. And it reinforces a core idea we keep coming back to: own the bottleneck, the chips, the memory, the power, the servers, because that is exactly where the scarce dollars are rushing. Notice that IBM's own servers and storage grew 37%. It was the mainframe that lost. Now, to stay humble, this is one quarter and one company. But finite budgets bending toward AI infrastructure is a signal well worth watching.
Here's how the market reacted to all this, and it is important to separate the reaction from the reality. Traders took IBM's warning and ran with it, extrapolating it into a fear that AI will replace the seat software, the kind where you pay per user, per login. So they sold the seats. ServiceNow fell about 6% and Adobe about 4%. But remember what we just said? IBM's actual software grew. So this sell-off is really the market pricing a fear, not yet a confirmed fact.
But on the exact same day, the software that benefits from artificial intelligence soared, and cybersecurity was the absolute standout. CrowdStrike jumped over 12%, Okta surged almost 11%, and Palo Alto networks rose almost 7%. And this one is not just a fear trade, it is grounded. More artificial intelligence means a drastically larger, more complex attack surface, with more machines, more generated code, and more autonomous agents to defend, so security spending genuinely rises. In fact, IBM itself said clients were distracted by industry-wide cybersecurity concerns last quarter. So the honest read is that money rotated out of the software AI might replace and into the software that defends AI, plus data names like Palantir. But whether AI is truly eating the seats is a fear to be tested when ServiceNow and Salesforce report on the 22nd. The software ETF was up just 1%, and that mild green completely masked the split underneath.
Zooming out to the sector level, that split drove a massive rotation under the hood of the market. Semiconductors and the broader technology sector clearly led the way, with the tech sector up 1.3% overall. And because risk appetite returned with a vengeance, we saw a total unwind of the defensive trades that everyone crowded into yesterday. Healthcare fell about 1.9% today, and consumer staples fell 1.4%.
That is exactly the opposite of Monday's price action. Energy and financials were modestly higher, supported by the bank earnings and oil prices. What we witnessed was a very clean, textbook risk-on rotation. Money flowed straight out of the safety-first, defensive hiding spots and poured right back into growth and technology. The market looked at the inflation data and decided it was safe to swim in the deep end of the pool again.
Let us touch on the geopolitics, keeping it strictly to the market facts. The United States is officially reinstating a naval blockade of Iranian ports. But importantly for the markets, President Trump reversed the 20% oil transit toll that he had previously floated for non-Iranian ships traveling through the Strait of Hormuz. That reversal was a massive sigh of relief for global trade.
It really was. The market was terrified of what would effectively be a massive tax on global energy transport. With that toll taken off the table, the fear of an imminent, structural global trade shock eased considerably, and the geopolitical risk premium in the energy markets deflated. Oil steadied near $80 a barrel. While it was up about 2% on the day, the price action was far, far calmer than the violent 9% spike we endured on Monday. The panic trade cooled off.
Back on the domestic front, we had some real tension with the Federal Reserve today. Fed Chair Warsh was on Capitol Hill testifying to Congress, and he struck a decidedly hawkish tone. He explicitly stated there is no tolerance for high inflation and dropped a heavy hint about a coming policy regime change. Normally, language like that from the Fed chair would send equities diving for cover.
And yet, bond yields fell and stocks rose anyway. The market essentially listened to him, looked at the cool June inflation print, and completely shrugged off the hawkish rhetoric. For today, at least, the hard data beat the central bank tough talk. But we should definitely keep that regime change message filed away. The market is ignoring him today because of a good data point. But a regime change at the Fed is a longer-term structural signal that we cannot afford to ignore forever.
Cutting through all the daily noise, the big structural stories really validated themselves today. The semiconductor thesis stayed incredibly strong. Look at TSMC. They're up around 40% this year, and the major chipmakers remain on track for enormous cash generation. Materials also caught a strong bid today, with Vail up 2.9%, Freeport climbing 3.3%, and rare earth names rising 2.6%. Gold recovered its footing, too.
The one glaring soft spot, aside from legacy software, was the NeoCloud artificial intelligence rental space. Nebius was down almost 8% today as worries about intense compute competition start to mount. But the net result of today's action is clear. The core thesis of owning the hardware and the energy bottleneck got substantially stronger today. Meanwhile, the thesis of owning traditional, seat-based software took a massive warning shot straight across the bow.
Stepping all the way back, the market made a very deliberate choice today. It embraced the cool inflation data, and it looked right past a hawkish Fed chair and a historic crash in IBM. The result was a broad, risk-on, semiconductor-led bounce. But the signal to carry forward from IBM is not that AI is killing software.
Exactly. The real signal is that IT budgets are finite, and the frantic scramble for scarce AI hardware is crowding out everything else. It just happened to hit IBM's mainframe first. The big picture red stays the same, and maybe gets stronger. The capital keeps rushing toward the shovels, the chips, the memory, the power grid, the physical infrastructure. And within software, The market is betting on the tools that defend and enable artificial intelligence over the ones it might replace, though. To be humble, that last part is a bet on a fear that still has to be proven when the software names report. This is a likelihood read, and we stay humble as the data evolves.
Looking ahead, the catalysts are going to keep coming fast and heavy. On Wednesday, we get earnings from ASML, the company that literally makes the machines that make the most advanced chips in the world. That is a critical read on global chip demand. Then on Thursday, TSMC, the world's most important foundry, reports their numbers. And the real test of IBM's warning will arrive later this month when pure software names like ServiceNow and Salesforce report. Will they confirm that budgets are being squeezed?
That is the multi-billion-dollar question. And I want to add one more general observation for caution. Remember that today's beautiful, cool inflation report was June data. That was captured before the massive oil price spike we have seen in July. The next inflation print could look very different if energy stays elevated. So while today was a great day for the bulls, this is an environment where it pays to stay highly selective, and definitely not a market where you want to chase extended rallies blind.
To sum it all up in one line, a cool inflation relief rally masked the day's real signal. And that signal was not that AI is eating software. It is that the scramble for scarce AI hardware is crowding out the rest of the IT budget, and IBM's mainframe was the first big casualty. The market is starting to separate the infrastructure shovels from the legacy seats. But just how much AI is really eating software, we will find out when the software giants report later this month.
It really is. Thank you all for joining us today on The Working Thesis. As always, please remember that the topics we discuss are for informational purposes only. So please do your own diligence and research before making any investment decisions. Have a great rest of your day, and we will see you right back here tomorrow.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.